Headwinds versus Green Shoots, the Post-Pandemic Economy and Non-QM Market Drivers. Our moderator is Kahan. Jack, please take it away.
All right, thank you. Thanks everyone. Thanks everyone for coming, and thanks to IMN for hosting this event. My name is Kahan. I am the global head of RMBS for Kroll Bond Rating Agency. KBRA is a global full-service rating agency. Our RMBS group covers all RMBS 2.0 asset classes, including non-QM, where we've rated about 60 transactions over the last year. As I said, I'll be moderating this panel for you guys, and we have Nick Roberson. He's the West Coast Regional Director of Sales for Sharestates. He's been in the mortgage industry for about 30 years, and he's the current president of the East Bay chapter of the California Association of Mortgage Professionals. With the affordability issues that we're having, I would expect that lenders and maybe some folks in this room are thinking about, okay, where's that volume going to fill back in from? And considering the higher LTV products or affordability products, I could definitely see that. One of the things that we've seen become a larger portion of what we call the non-QM space, although technically not really non-QM, is the non-owner OC product, the investor loans, DSCR loans. That's become a larger and larger portion of the market. And it's kind of interesting because that used to be, I think, one of the more longer duration things. When loans were prepaying at 30 and 40, you like to put those in and kind of slow things down. But maybe they're turning out to be some of the faster now. So Nick, I want to turn to you and talk a little bit about how this current market environment might be favoring different types of non-owner OC product that we really haven't talked about, whether that's DSCR, fix and flip, SFR type product. What's kind of hot right now in the non-owner OC space that you're interested in, and what do you think for volume expectations for that product?
It's funny, I was talking about that before this. I asked that question of 10 different people, and I got 10 different answers. And the funniest answer I got is that there's no hot product right now because of the instability in the market. But I think fix and flip is still very popular. We went from being heavy on the DSCR type loans. The credit box has gotten really tight for that, obviously. We're starting to see the DSCR threshold come down, which I'm seeing. I talked to someone in the room this morning, they were at 0.75. I see a lot of that. I saw someone at the last conference that was down around 0, which I'm not sure how that works, but at that point I'm like, don't really understand. But fix and flip is still very popular. There's still deals to be made. Even though the valuations, which I'm a valuation guy in the past, valuations have started to stabilize a little bit, which I kind of like to see. We're not seeing this huge increase in valuations on the properties, but I think with the current credit box being a little bit tighter, we're starting to see more ground up. That's really the question I get asked most is about ground up and ADUs right now. Everybody wants to know about ADUs because that's a big thing. Obviously with non-owner occupied type situations, the fix and flip is the biggie. We still get people come to us for the term loans, but it's more the people that have larger portfolios that are looking to leverage that to buy additional portfolios of their houses, things like that. As far as non-QM though, I think really right now we just have to wait till the market stabilizes a little bit. The interest rates increased so fast that people just didn't get time to get used to it. In the past, the interest rates slowly climb. They get used to the change in the interest rates. This happens so fast that they're still expecting yesterday's rates today.
Yeah.
And people always ask me, how's the rates today? I always tell them, they're fantastic. They're like, what are you talking about? The rates are going up. I'm like, well, unless you have a time machine, today's rates are great. Because they're not going to be able to get yesterday's rates. They don't exist anymore. They're still great. The rates are great. They're still historically great.
Yeah.
I hope I answered your question.
It did, Nick. Yeah, thanks. Nick, I know you do want to talk about ADUs, and we are in California, so just curious from your perspective, and I'm searching here for any green shoots, because this is a little bit more pessimistic than I was hoping for, but it is what it is. SB 9, different types of legislation going on, obviously California kind of a poster child for that, but maybe talk a little bit about that legislation and ADU, since California is such a large state and that opportunity might be great. Is that driving any additional potential demand, as you mentioned, in the ADU space? Are there any other legislative workings that are going on that you think might have give some other lift to either the non-owner OC space or otherwise?
Well, yeah, as far as legislation goes, you guys are all aware of what the new assembly bill that they were trying to push through or they were trying to get through that was going to tax the fix and flip guys on exit 25% or something like that. I did speak to the president of California Association of Mortgage Professionals yesterday, who at their ledge day learned that that was probably going to get shot down. So I know that a lot of my clients are going to stand up and applaud. It's not structured properly. It's just not a solid enough bill that that's going to go through, they don't think anyway. And I got my fingers crossed that is true. As far as the SB9, the adding of ADUs and being able to split, I'm sure everybody in the room is familiar with it because it's happening in other communities throughout the country as well. But the ability for a homeowner to be able to, like SB9, where they can split the property, so they got an SFR, they can split the property, and basically add an additional unit to the one that they're occupying as well as build a duplex on the other one. That works out great, I think, for the non-QM sector. As far as private money where we're dealing with non-owner occupied properties, we're still trying to figure out how that all works and how that all fits in, because I think the California, and I could be wrong, but I'm pretty sure that under the California law that there has to be a primary residence that's occupied for 3 years or something like that by the homeowner. With that said, that will open up opportunities, I think, down the road when these individuals sell their properties and give investors an opportunity to go in and what was once a single family, now they can buy 4 units or what have you. AB 10, that's a good one for the private money side, people that are investing in multifamilies, because that allows up to 10 units to be constructed. So I think anything where a homeowner that can add value to their property, if it's a homeowner that already has an ADU and now they have the ability to add additional rental income to their property, which improves their quality of life, improves the housing situation in California. We all know there's an issue, there's just not enough houses, which is why I was speaking earlier of ground up. Everybody asks me about ground up these days, that's what everybody wants. The trick is in our space with everybody up here and all the lenders in the room is to figure out a way to help these people finance this ADU construction as well as the others, because I think there's still a lot of hesitance there. There's local municipality guidelines, rules, and laws, and they have to figure out how to interpret it, all those different things. And you also throw in the STRs. So the Airbnb and VRBO income, that comes into play as well. That's huge right now. I get asked that question all the time, and I love that underwriting is becoming more, I'd say across the board, people are starting to go off of the Airbnb and the VRBO income that's generated over a time period, let's say 12 months, versus forcing them to use the 1007 on the appraisal, which typically the properties that have these successful Airbnbs and VRBOs, they perform much better in the short term than these other typical rental does over the long term. So that's really the biggest adjustment that these bills have right now is, I think once the lenders figure out how to finance these and how to leverage them and then build them into their credit boxes, I think that's a good thing for any municipality. Like Nashville is a good example too.
Right.
You know, any of those areas.
All right, thanks. So what's the typical profile of a non-QM DSCR loan borrower? Generally landlords with one rental property, seasoned investors. What does this look like?
You know, if you had asked me that question in January, I would have said they were seasoned investors who were looking to capitalize on the rates and for their portfolios, et cetera. We're still seeing some of that, obviously not on as large scale. Right now, it's more the small investors, the landlords that have 1, 2, 3, 4 properties, and they're looking to leverage some of the higher valuations now, the higher rents that they're getting on these to either add, again, some of them are trying to add units to these properties, or they're looking to leverage those loans to basically increase the size of their portfolios. And for the smaller ones, they need the additional capital to buy in this market, obviously. So, and as the credit box opens back up again a little bit for the DSCRs, I expect we'll start to see even more of those types of individuals getting DSCR loans.
I mean, it's interesting, the agencies allow less seasoned borrowers, right, with fewer number of mortgage properties in, but they obviously don't allow the DSCR product. So it's interesting to see some more of those coming into this space. All right, well, so really appreciate everyone coming out. Thank you, panelists. Excellent job.